Hello everyone, a very warm welcome. My name is Nicholas Tan from Kenanga Futures, Berhad. Thank you for spending your precious time to join our webinar today. It's a joint collaboration with CME Group in our effort to create awareness and provide education on listed derivative to the participants. Please take note also that futures and options trading involves substantial risk due to leverage factor and may not be suitable for all investors. This webinar is purely for educational purposes. Kenanga Futures, Berhad accepts no liability whatsoever for any direct or consequential loss arising from any use of the content of this webinar. Today, we have Mr. Chong here, and he's going to share with us on what next for gold in 2019, the second half of 2019. So without further delay, I would like to kickstart our webinar today by welcoming Mr. Chong. Mr. Chong, over to you.
Good evening, everyone. Welcome abroad. My name is Chong. Okay, today we are going to cover gold for the second half of this year. Okay, as usual, this is a disclaimer I have to publish before I continue with my presentations. Okay, today the agenda will be some basic introduction about gold and COMEX Gold Futures contract, and then we are going to cover the reason why you would like to trade the COMEX Gold Futures contract. Then we will be assessing the factors that will have impact on gold prices. Then we will proceed with some market outlooks, both fundamentals and also technicals. And last but not least, we have a Q&A sections. Okay, so do feel free to ask if you have any question later on. Okay, introductions. Okay, some information about gold. So why gold is so precious and valuable? In the history of mankind, since as early as the dynasty of Egypt, they have discovered gold, and it has been so precious. One of the main reasons is because of the rarity of gold. It is limited in terms of amount of gold on Earth, and another reason is that it is difficult to find and dangerous and expensive to extract out from the underneath the ground. Okay, and another attribute about gold is basically gold is a metal that is very stable, that have non-toxic, which is not harmful to human, and it is an untarnished metal. And due to the malleable of this metal, it makes it so ideal to make jewelries. Okay, and then last but not least, you cannot find another type of metal on Earth that possess the yellowish golden metallic color. The nearest we have is the reddish one, will be copper, but it is not as shiny and as attractive as gold. Okay, in the history of mankind, gold has been used to produce 50% in jewelry, 40% now in investment, and 10% in industry, covering electronics, dental, medicine, or even in cuisine. Okay, that is the usage of gold. Okay, this is the major gold demand sectors, mainly jewelry, investment, electronic, and dentistry. Okay, on the central bank also use gold as a reserve to safeguard their monetary belongings. Okay, and then also we have it in medicine, trophy, foods, buildings. Okay, when covering a commodity, basically we will have to, you cannot run away from supply and demand factors. So after covering the intro, I will be covering the supply factor now. So you have this is the map that consists of all the gold mines by country. So we have the top production country on 2018, which is China, Australia, Russia, United States and Canada, the top 5. And then the next image here will be all the mine location that has been discovered and that are in mining and discovering progress. Okay. And then this will be the top 5 largest gold mines in 2018 by productions. We have the first one nearest to us will be the Grasberg mine in Papua, Indonesia. And then we have 2 in Nevada and 1 in Russia. 3 in Nevada, US, and 1 in Russia, actually. Okay, do you know that there are gold in seawater, and in total there are approximately 20 million pounds of gold, and you can if you have the technology, basically you can actually extract gold from the seawater, but due to the limitation of technology at the current state, it is impossible to extract gold from seawater because of the cost is way too high and inefficient. So, and historically, there has been a lot of scams cheating people into investing in seawater gold extraction scheme. And if you manage to make one, so please be cautious. Okay. Okay, this is the major exporting and importing countries by 2018. Okay, you see top exporters, Switzerland, Hong Kong, UK, US, Australia. And you have top importers, mainly Switzerland, China, India, UK, and Hong Kong. Okay, and you might have some question here, why Switzerland is not, there's not much mine, basically there's very limited mine in Switzerland, but why it is the top exporter and importer of gold? This is basically due to the reason half of the biggest gold refinery are located in Switzerland, and due to the strategic location of Switzerland as a financial center and also strategic location in terms of logistics on the entire Europe. So basically what happened is they basically import the big gold bar, that 12.4 kg gold bar, the biggest one, and then they will refine it and process it into smaller gold bar like 1 kg or even like coins and export out. So as you can see on the trend here is that you have all the non-producing country, but is the biggest exported country because of the financial status. Okay, and on the import side, we have for purely jewelry demand, we will have top will be China and India, and also Thailand. Other than that, is mainly for producing gold bar in smaller size. Okay, this will be the COMEX Gold Futures contract specs. Okay, the underlying for this contract is actually minimum 99.5 finers of gold. The contract size is 100 troy ounce, and 1 troy ounce is equivalent to 31 gram for your information. The minimum price fluctuation is 0.1 equivalent to 10 US dollar per ticks. Okay, available month will be 3 listed consecutive month and any even month. When you trade this contract, it is ideal that you choose the active even month to trade and avoid the odds month, and because of liquidity. Okay, it is a 23 hours market covering from 6 a.m. Malaysian time to 5 a.m. and we are, if it is not in daylight saving time, we will be 7 a.m. until 6 a.m. Okay, so trading will terminate last business day of the day, and it is a deliverable contract. Latest margin will be 4,400. This is last updated yesterday. Okay, next we'll have the statistics of COMEX Gold Futures contract. So the average daily volume stands nearly about for 400 over thousands averagely daily, and June is slightly lower. The volume improved is basically due to increased uncertainty over Brexit and also trade war. And then if you are concerning about liquidity issue during our Asian hour time, not to worry, because statistics from CME show that even from our Asian time zone, 6 a.m. to 6 p.m. or 8 a.m. to 8 p.m., the trading volume is actually, average daily volume is actually quite huge. It is actually about a quarter of the total average volume of the 23 hours market. So liquidity is not an issue even during Asian hours. Okay, and in terms of money interest, is over 500,000 contract averagely, and the range for trading range, meaning the high and low of a daily range, will be about $10, which is 100 ticks, equivalent to $1,000. This is actually the price movement from high to low, the daily range. Okay. Next, if you find that the normal contract is a bit high, or maybe you are not sure you would like to try a smaller contract, we have the COMEX Micro Gold Futures contract here to suit your need. Okay, it is the same. The underlying is still the same, 99.5 finals, but this is 1/10 of the normal contract, which is 10 troy ounce. Minimum fluctuation still 0.1, which is equivalent to $1. Available month same, is all even month with nearest 3 consecutive months. Sorry, this is all correction. The contract month will be all evens month, and trading hours is the same. It's also a deliverable contract, but the margin is relatively lower. It's also 1/10 of the normal contract, which is $440. Okay. Okay, this is the statistic for micro gold futures contract. Average daily volume, we have around 27,000 in July and 24,000 in June. So monthly open interest, 18,000, and daily trading, which is also about $10 fluctuation, high low, equivalence to 100 ticks or $100. Both the micro and normal contract movement are actually quite in synchronization, so there won't be like one ups and one down, so not to worry about that. Okay, this is the statistics of all the global gold futures contract in various exchange. As you can see that the top volume is still come from COMEX Chicago itself, and followed by Shanghai Financial Exchange gold futures contract, and the third one will be .com, followed by London Metal Exchange. Okay, when you trade gold, there are other related gold prices that you might need to watch out for, which is the London Bullion physical price, or Shanghai Gold Exchange, also physical price, and this is a Shanghai Futures Exchange price. And another one, you have the gold ETF in iShare and SPDR. This is the other prices that you need to pay attention to. Okay, this is the historical price since year 2000. As you can see, it peaks on 2011 at 1888, and the lowest will be at 2001, which is 255, quite a significant increase. Okay, so now we are covering reason to trade the gold futures contract, and we will be assessing the advantage of this futures contract. Okay, so the key features of this futures contract is, the first will be, it is a much fairer price spread as compared to physical gold price, because the difference between the bid and ask is basically 0.1 difference, which is equivalent to 10 US dollar for the normal contract and 1 US dollar for the micro contract. As compared to physical gold price, you have a big difference in bid and ask. And also even in the context of if you invest in gold passbook, the difference between ask and bid is normally at around 6 to 7 ringgit in Malaysia. I'm talking about Malaysia Bank's gold passbook is about 6 to 7 ringgit price difference per gram. Okay. And then with this futures contract, you basically have the flexibility to retain it in paper asset, or if you make the decision to keep it for a longer period, you can basically take deliveries. And it is also a form of direct exposure to the gold market. And you will have no worry about liquidity issue here because of heavy participants from related industry players like jewelers, hedge fund, miners, and money managers. And okay, and then also history is actually alternative to temporarily hedge against equity market uncertainty, because traditionally gold will be an instrument where it will help you to improve your entire portfolio risk adjusted return. So historically it's been proven. So it is good to have gold in your portfolio. So, and then you have 23 trading hours market, so you can basically do the hedging anytime as you like. That's flexibility is there. And also, of course, when you trade futures contract, leverage is one of the factors where you can control large notional value of exposure with relatively small amount of money. And also, because this is a futures contract, it is guaranteed by the exchange, you basically eliminate counterparty risk and also the quality that you are going to get when you take delivery. Okay, besides that, as futures contract is a paper form gold, so you have zero storage cost. You basically don't have to get safe deposit to store the gold. And also in the concept, if you invest in ETF, you will be charged management fee by the ETF. So for futures contracts, there is no management fee. That is one of the advantage. Okay. Okay, next, we'll be assessing the factors that is impacting gold prices. Okay, first and foremost, any commodity, you cannot run away from supply and demand. So basically for gold, the worldwide demand for jewelry, electronic industry, or other gold fabrication industry, and also safe haven demand will be the biggest factor. And then after that, we will follow by world economic event, basically related to uncertainty in the political arena or in the financial market. Okay, and then also when you have riskier as when you have a bad movement in riskier asset like stock market, just what you witnessed yesterday, as the Dow down by more than 600 to 700 points, you see that gold price will go up. So it is an inverse relationship. So stock market performance will have an inverse relationship with gold prices. And also a short-term impact will be the central bank interest rate decision, especially the Federal Reserve, because the interest rate determined by the Federal Reserve will have a direct impact on US dollar, which is an inverse relationship. And also some important economic data like non-farm payroll, inflation, GDP, or CPI. And then, of course, the World Central Bank Gold Reserve is also one of the biggest factors, because this institute basically can buy big numbers of quantity of gold or sell big number of quantity of gold. And last but not least, we will have the money manager exposure. This is actually a commitment of trade report that if you are our client, we also send this on a weekly basis to client to show you that the latest exposure of money manager towards all the commodity that we offer. I mean, in terms of futures contracts. Okay. So the next will be all the slide with gold prices and the relationship with the factors. Okay, this is a slide showing you that gold prices did react to some important economic event like gold standard, central banks selling, European zone debt crisis, and the latest we have the Brexit. Okay. And this is also the same. This is covering only from 2018 onwards until now. As you can see, I'm not going to cover all due to time constraint, but just to give you an idea that gold price did react to important political or economic events. Okay. Okay. In terms of seasonal performance on a monthly basis, okay. Gold, the definite trend here identified will be in the month of January, where you will have 7 months. Throughout the 10 years, you have seven months of winner and 3 months of loser. And on the opposite, on the month of March, you have 7 loser and 3 winners. And the most significant will be the month of August, where you have 8 winners month and only 2 loser months so far. Okay, this is seasonal. And then this is the inverse relationship between gold prices and US dollar. And you see that overall it is on the opposite side direction, where when US dollar go up, price of gold will come down and vice versa. But lately we will have a quite special development where the US dollar and gold prices go hand in hand. Okay, one of the reasons why this is happening is in terms of gold prices, it is because of uncertainty created over trade war, Brexit, and also the financial market has become a little bit more risky, and demand for safe haven has increased because to avoid riskier asset. On the other hand, you will see US dollar also go up. One of the reasons is because of the underlying US economics is good, and also the announcement by the Federal Reserve to start trimming their balance sheet. This meaning that they start disposing, there's not renewing any bonds, so this will make the US dollar stronger. So temporarily we have like in-line relationship, but overall throughout the years it is actually in inverse relationship. I have to highlight that. Okay, this is gold prices versus short-term interest rate, which is the US 1-month bill interest yield. As you can see, it is also in inverse relationship. During this period, it's a bit difficult to gauge because of the lower near zero interest rate policy by the Fed to give stimulus to the market after the subprime crisis. Okay, but after that, when things normalize, it is still in overall is still in inverse relationship. And you can see here next will be more significant will be the longer term interest rate over the 5-year US Treasury interest yield. It is in inverse relationship as well. And this is as mentioned in the first slide of the factors is the fund manager net position. As you can see, when money manager increase their net long position, the price of gold likely to go up. When the money manager have a net short position, price is likely to pressure downwards. Okay, so this is gold prices versus inflation in US, China, and India. As China and India will have the highest demand of gold in terms of jewelries and also investment. So that's why this is also another factor that you have to pay attention to. And then GDP, as this is the top three importing country, the usage of it will be in terms of central bank reserve and also jewelry demand and electronic industry demand. So when this country GDP is good, demand for gold is likely to increase. Okay, this is gold reserve versus price, gold price for central bank in Russia, China, and India, which is in a positive relationship. Okay, then we'll be covering the market outlook. Okay, first for the market outlook, we'll be covering some fundamental factors. So this is the gold supply demography overall for mine production and also recycle gold. As you can see, the supply is quite stable. Okay, next we will have the mine supplies, a subcategory. I trim out from the overall, which you can see gold mine supply is basically quite consistent. And then next we have a recycled gold, and we see a gradual downtrend of recycled gold supply, meaning to say that the people are actually keeping the gold more than trade in the gold. Okay, and this is the gold production cost based on all sustaining cost. This is actually a standard of calculating gold production cost, and as you can see, the cost is actually below 1,000 US dollar per ounce. Okay, next we will be covering the demand category. So this is the overall demand demography. As you can see, the overall demand as you can see that in pink circles, the first and second quarter of this year have seen increase in gold demand as compared to first and second quarter last year. Jewelry demand is still stagnating, but is not recorded a big decrease. Okay, gold investment, you can see gold investment basically is in the form of gold bar and coin. So you see some gradual slowness in gold demand for investment in terms of gold bar and coin. And then this is the central bank and other institution buying. As you can see that central banks around the world are accumulating gold. As you can see here, the latest quarter is recording a substantial increase in terms of central bank buying. Okay, this will be the top 20 gold reserve by country or institution, namely the first United States, of course, and then Germany, IMF, Italy, France, Russia, and China mainland. Okay, Malaysia, so far our reserves stand at 38.9 tons of gold. Okay, this is for global technologies sector for gold demand. And you can see that the demand is quite stable since 2015 until now. Okay, this will be the summarize of the supply and demand in one slide with figures. As you can see that supply is rather consistent, and you can see that demand actually peaked in the fourth quarter of 2018, and then now started to slow. But normally, gold demand will started to increase during the last second quarter of the year. So you have to keep in mind, because due to in India is actually festive season, and also some auspicious wedding days. This will push up demand for jewelry. Okay, as you can see that we have still recorded a surplus of gold, but the increase has been reduced in terms of magnitude. Okay. Okay. So this is longer term supply and demand summary for gold. As you can see that we are still in surplus in a yearly basis. Okay, this is the summary for fundamental factors. So overall, the supply increased marginally by 4.35%. Overall demand increased much quicker than the pace of the supply, which is 7.6%. Largest contribution so far for the second quarter of this year as compared to the first quarter will be mainly in central bank buying due to uncertainty over global development. So as you can see that Poland, China, and Russia central bank accumulate the most gold for second quarter. And then ETF holding also increased by 40%. And we have jewelry demand up, recover by 3.35% because of number of higher auspicious wedding day in India, and also, but jewelry demand in China still remain in the decline. Technology fabrication demand is still quite stable. And then, but demand for gold bar fell by 15.4%. Okay. And overall gold surplus was narrowed by more than 40% in terms of the difference between last quarter and this quarter, and the second quarter. Okay, for the fundamental aspect outlook, we are actually calling for a neutral to mildly bullish view for fundamental factors for gold. Okay, next we are going to covering the outlook for economy, policy, and geopolitical category. First thing is, as you are already aware, prolonged trade war and the non-fruitful trade negotiation between US and China continue to spark concern and create uncertainty. This will result a higher tariff, and also, as you have know yesterday, China are starting to devaluate their currency, and in terms of U.S. economic, underlying U.S. economy remains sound and solid, but it has somewhat peaked and now is having a small correction. This is mainly contributed by a higher US dollar and also the trade war. But employment is remain high in US, corporate earnings still meet expectation, and inflation remain in control. So underlying US economy, there's no problem for now. Okay. For the Federal Reserve, the latest statement in 1st of August, they are actually, the statement are signaling more towards an adaptive interest rate policy rather than a completely dovish policy. So these actually have a negative impact on gold prices, because when they are not that dovish, basically US dollar will not go down that much, and this will resulted gold price to not to go up. And then China economy remains sluggish, and you can see that there has been quite a number of stimulus implemented by Central Bank of China, and also the latest trend will be increasing default in corporate bonds. This is a issue that you might need to pay attention to. And then on back to US, we have the inversion in interest yield in the treasury area. This will keep gold price check, and investing are paying close attention to this inversion in Treasury yield curve. Okay, and then ECB, European Central Bank, plans stimulus with either interest rate cut or renewed quantitative easing. This is going to have an impact on gold prices also. And we have the Boris Johnson elected as Prime Minister of UK, and his policy towards the Brexit will be, regardless of whatever the solution, he will insist on a Brexit, be it a soft or hard Brexit. So when there is a hard Brexit, this will weaken the ECB as a whole, and thus will affect gold prices. And also, latest one will be the CBGA4, which is the Central Bank Gold Agreement, agreed by quite a number of central banks. This agreement actually involved all the participation central bank agreed not to sell gold in an uncontrollable manner. So there is a limit and percentage of gold that this central bank can sell off during the agreement. And for your information, this agreement is going to expire at the end of September this year. So it is still unclear how this is going to impact the gold prices, but you have to be aware of this. Okay, not some things that I would like to highlight here is the US Treasury yield curve inversion. So this basically is more when the interest rate yield in short-term Treasury bill are higher than the longer-term Treasury bonds, which is normally comparing the 3 months paper and the 10 years bond. So this is actually a normal development, because normally longer-term Treasury will bear a higher interest as compared to shorter term. And one of the reasons why this happened is because investors are not optimistic about the near term or medium term economy as compared to the longer term. And then another possibility is also they are expecting Federal Reserve to cut interest rate by a greater extent. So this is actually impacting the Treasury yield curve. And then this development is regarded as the leading indicator in the impending of recession, as historically all recession are preceded by interest yield curve inversion in treasury bonds. Okay, average span of the inversion can be as, and subsequent of inversion has been about 11 months, within the range of 5 months in 1973 and 16 months before the subprime 2006 to 7, before the subprime crisis. Okay, so the impact is more, this development will have more pressure on consumer, with the consumer will adjust rate mortgage or loan because of higher monthly commitment that have to service the interest rate. Okay, and fixed income investor will avoid riskier asset and jump into safe haven related products like gold. And then for those company with borrowing, this will lower their profit margin, but this is not affected by those company with relatively small debts or cash rich company. Okay, and this is the statistic of the equity market drawdown of all the recessions preceded by yield curve inversions. The most significant one will be the latest we have in the subprime crisis, which is down by 56.8%. Okay, this is the latest yield curve rate that I extract from the US Treasury Department website. Okay, so as you can see that As for now, you have the 3 months, the 1, 2, and 3 months is actually interest rate is actually higher than the 10 years. So we are in the US, there is still a yield curve inversion happening. So the longer this happens, it is not good for the economy and equity market, and this will lead to a more demand for safe haven like gold. Okay, for this category, the outlook we are calling for a mildly bullish view. Okay, last one to cover will be the technical outlooks. Okay, as you can see, this is a weekly chart, continuous trading contract for COMEX Gold. As you can see, gold prices basically has been break out from the range, and it has been trading now above 1,400 per troy ounce. So this red line is has turned from resistance to become support. So for now, in terms of weekly chart, it is still recording higher highs, so it is bullish in terms of the weekly candlestick, and in other indicators, MACD is been rising and is continue to tick higher from the zero line. RSI is near overbought. Okay, and then this will be the point figure chart. Okay, as you can see, it's also reaching higher high, and we recorded a higher low, and it has break the major resistance that turns to support. Okay, for technical outlook, we basically giving a bullish view on technical. So this will be the outlook for gold from us. Okay, so for trading strategy suggestion, okay, if gold price fall back to 1365, so if we actually expect it to come back to the previous range of 1,002 to 1365. So if market fall below within this range, basically the ideal strategy will be to buy on weakness or support and then sell at resistance or strength. Okay, if it is still trading above or maintaining above 1365, basically you are actually advised to buy on strength, or even you can actually buy on support. But overall, as long as price is above this 1365, it is still bullish, and the buying momentum can still be going further up. So you can actually adopt a more aggressive strategy if gold price stay above 1365, and if it fall below 1365, basically you can just sell on weakness or break of support. Okay. Okay, so that's basically my presentation about gold. So now we'll leave some room for questions. Back to you, Nicholas.
All right, great. Thank you, everyone. Should you have any further queries, please feel free to drop us an email at bcrm@kenanga.com.my. We appreciate you being here and hope that you enjoyed the webinar today. Please take a minute to rate our webinar, and your feedback is highly appreciated. Thanks again for joining us, and hope to see you again in our futures event.